Subscription call to action. Before we begin, I'd like to invite you to subscribe to this channel. We focus on thoughtful, disciplined financial analysis, exploring the forces that shape markets and wealth without the noise or hype. If you're committed to understanding complex financial dynamics and building genuine financial resilience, we'd be honored to have you join us. Subscribe button, red. Now, let's explore today's critical topic. We are living through a moment of profound financial consequence. Multiple forces are colliding simultaneously, forces that rarely align this directly or this intensely. Silver, a precious metal long overlooked by mainstream investors, is beginning to receive serious attention. Geopolitical tensions are escalating in ways not seen since the Cold War. Yields on government debt are climbing to levels that challenge the fundamental economics of modern monetary systems. And underneath it all, a global debt structure exceeding $240 trillion sits like a geological fault line, waiting for the pressure to shift. This is not a moment for panic. It is, however, a moment for clarity. The question we must ask ourselves is straightforward. How do these forces interact? What do they tell us about the future? And most importantly, what should we do with this knowledge? These are not rhetorical questions. They demand serious, structured thinking. That is what we're here to provide. Let's begin with the $240 trillion figure. This number represents outstanding debt across all sectors, governments, corporations, and households, across the developed and developing world. To contextualize this, global GDP is approximately $105 trillion annually. This means the world is carrying debt obligations equal to roughly 2.3 times its annual economic output. That ratio has been climbing for decades, particularly since 2008. Why does this matter? Because debt is fundamentally a claim on future economic output. When debt grows faster than the economy itself, a condition called debt accumulation, the system becomes structurally fragile. Eventually, you reach a point where servicing that debt becomes mathematically difficult. We are approaching that point. Governments have historically responded to accumulating debt in three ways. They can grow the economy faster, reducing the debt to GDP ratio. They can default or restructure debt, wiping out creditors, or they can inflate their way out, paying off nominal debt with devalued currency. Growth is slowing. Default is politically unthinkable, so we're left with the third option. And that brings us to yields. Yields on government bonds are rising. In the United States, the 10-year Treasury yield has moved above 4% and touched higher levels. In many developed economies, yields are climbing across the curve. This creates a peculiar problem. When yields rise, the cost of servicing existing debt increases. More importantly, higher yields make borrowing more expensive going forward. The very mechanism that might inflate away old debt simultaneously makes new debt harder to finance. Investors, sensing the vulnerability in the system, are demanding higher returns. They're asking for more compensation for risk. This is rational behavior. This is markets working. But it also accelerates the pressure. Here's the dynamic that matters. Governments need to keep borrowing to function. They need to service existing debt, pay current expenses, and manage fiscal obligations. But as yields rise, each new round of borrowing becomes more expensive. This creates a vicious spiral. Higher debt service costs, more borrowing needed, higher yields demanded, more expensive borrowing. At what point does this become unsustainable? We don't know precisely, but every month that passes, we move closer. Geopolitical conflict acts as an accelerant to monetary and fiscal stress. When tensions rise, several things happen simultaneously. Investors become risk-averse, capital flows to safe havens. Central banks face pressure to respond with policy support. Governments increase defense spending. Supply chains fracture. Inflation pressures can emerge. All of these dynamics push in the same direction. They stress the existing financial system. Consider what happens when a major conflict emerges. The European experience since 2022 provides a clear example. Energy markets spike. Inflation accelerates. Central banks feel compelled to tighten policy even as governments increase spending. The classic guns and butter dynamic, trying to spend simultaneously on defense and social programs while managing price stability. This is fiscally unsustainable. It forces choices. And those choices typically result in either higher inflation, higher yields, or both. We're currently in an environment where geopolitical risk is elevated. Multiple potential flashpoints exist. The financial system is simultaneously burdened by excessive debt and constrained by rising yields. This is not a stable equilibrium. Silver historically has served three functions in financial systems. First, it is a tangible store of value, an asset that exists in physical form, not dependent on any institution's creditworthiness. Second, it is industrial valuable, used in manufacturing, solar technology, and electronics. Third, it is psychologically powerful, carrying centuries of monetary significance. When financial systems experience stress, precious metals matter, not because of superstition or mythology, but because of something more fundamental. They represent a form of wealth that is not someone else's liability. Let me unpack that idea. When you hold a stock, you own a claim on corporate assets and earnings. When you hold a bond, you own a claim on future cash flows backed by an institution's creditworthiness. When you hold currency, you own a piece of paper with value only because others accept it. But when you hold physical precious metals, you hold something with intrinsic value that doesn't depend on any counterparty's ability to pay. In a period of rising yields, currency devaluation, and geopolitical risk, this distinction matters profoundly. Silver has historically been one of the most undervalued precious metals. Gold captures investor attention. Platinum has industrial prestige. But silver trades at levels that seem disconnected from its fundamental supply-demand dynamics and its historical monetary significance. Currently, silver is being explored by two constituencies. Institutional investors are beginning to view it as an inflation hedge and a diversification tool. And central banks, long dormant from precious metals accumulation, are becoming active buyers. When institutional demand rises for an asset with constrained supply, and when that asset becomes cheaper on a relative basis, you create the conditions for significant revaluation. We're not making a prediction here. We're simply noting that the conditions exist. Beyond monetary considerations, silver has genuine industrial demand that is likely to increase substantially. Solar energy technology relies heavily on silver. As the world shifts toward renewable energy, whether driven by policy mandate or economic incentive, silver consumption will likely rise. This creates a fundamental supply-demand imbalance. Silver supply is relatively fixed. Demand is growing. That gap typically results in price revaluation. Additionally, the transition toward higher yield, inflation-adjusted returns is pushing institutional portfolios to reconsider assets they had previously dismissed. Silver fits that brief. Every asset goes through a cycle of recognition. Understanding where silver sits in that cycle is crucial to developing rational strategy. The asset is overlooked, considered unfashionable, or forgotten. Prices are low. Few investors pay attention. Silver has been in this stage for years. Early investors and specialists begin to recognize the asset's value. Whispers emerge. Prices begin to move. More sophisticated investors become interested. Media attention accelerates. FOMO, fear of missing out, drives retail interest. Prices move dramatically. Less sophisticated investors enter. Valuation becomes stretched. Price peaks, often on absurd valuations justified by pure momentum. Then sentiment reverses. Prices fall sharply. Most recent entrants are hurt. Silver appears to be transitioning from stage 1 to stage 2. This is actually the most dangerous moment from a behavioral perspective. Early investors feel vindicated. Entry points become emotionally attractive because you're getting in early. Herd behavior begins, but it's not yet obvious. This is precisely where rational discipline becomes essential. When uncertainty rises, investors' behavior changes in predictable ways. In stable, low-stress environments, people take risk. They reach for yield. They buy equities and emerging market debt. They leverage. They chase growth. But when uncertainty rises, when there are genuine questions about monetary stability, geopolitical outcomes, or financial system health, behavior reverses. Capital flows toward assets perceived as defensive. Asset classes that offer direct ownership or hedging value become attractive. This is not irrational. It is, in fact, one of the most rational responses to genuine risk. We're witnessing this shift now. You can see it in capital flows. You can see it in sentiment surveys. Investors are becoming more defensive. They're building hedges. They're reducing leverage. In this environment, assets like precious metals, which offer hedge value against monetary instability, deflation, and geopolitical chaos, become structurally attractive. Central bank behavior is the linchpin of this entire dynamic. What they do, or fail to do, in response to rising debt and climbing yields will ultimately determine asset price trajectories. Central banks face an impossible choice. If they raise interest rates to combat inflation or defend currency valuations, they accelerate debt service costs and can trigger recession. If they keep rates low or begin asset purchases, quantitative easing, they fuel inflation and devalue currency. This is the core dilemma of the modern monetary system. There is no choice that avoids pain. There is only a choice about where the pain falls and how it manifests. Historically, when central banks face this choice, they eventually choose currency devaluation over debt crisis. They print money. They keep rates lower than they otherwise should be. They support asset prices. This is not a moral judgment, it's a historical observation. When the financial system faces genuine instability, central banks lean toward monetary accommodation. And in that environment, precious metals become essential portfolio components. If you already hold meaningful financial assets, real estate, equities, bonds, retirement accounts, you face a specific strategic challenge. Your portfolio is likely concentrated in financial assets. Most of those assets are denominated in currency. Most depend on the stability of the existing monetary and financial system. This concentration, while comfortable, is risky. True diversification means moving beyond traditional asset classes. It means including assets that serve different purposes within a portfolio, assets that don't move in perfect correlation with stocks and bonds. Physical precious metals serve this purpose explicitly. They provide, when financial markets stress, precious metals typically appreciate as capital flees to safety. A portion of your wealth exists in a form that's not dependent on any currency's future value. As currency devalues, precious metal prices typically rise. In times of conflict or instability, tangible assets with global value become more important. This doesn't mean abandoning your existing portfolio. It means gradually rebalancing to include meaningful precious metal exposure. What does meaningful exposure mean in concrete terms? For most investors, 5 or 10% of total portfolio value in precious metals is a reasonable starting point. This is large enough to provide genuine hedge value. It's small enough that allocation doesn't require abandoning traditional assets. Within precious metals, the allocation might be divided between gold and silver. Gold provides primary stability and recognized value. Silver provides leverage to both monetary stress and industrial demand growth. A 70-30 gold to silver split by value, not by weight, silver is heavier, provides reasonable diversification within the precious metals category. This allocation is not aggressive. It's not a bet on silver reaching extraordinary prices. It's insurance. And insurance is rational when risks are genuine. Here's what makes this difficult. You're positioning against the consensus. Most financial advisors don't recommend significant precious metals allocation. Financial institutions profit more when your assets remain within the traditional ecosystem. Stocks, bonds, managed funds. There's little incentive for them to recommend positioning that goes against the consensus. But consensus is often wrong when it comes to financial markets. In fact, truly significant returns come from being positioned ahead of consensus shifts, not betting against consensus, but simply being in place before the crowd arrives. The psychological challenge is toleration of temporary regret. If precious metals don't appreciate immediately, you will feel foolish. Your traditional financial assets may outperform. You may question your decision. This is normal. This is expected. And this is where discipline becomes essential. A practical approach to implementation involves gradual, systematic accumulation rather than lump sum allocation. Consider directing a portion of regular savings, perhaps 10% of ongoing contributions, into precious metals, specifically silver as the growth component. This systematic approach accomplishes several things. It builds position without concentration risk. You're not betting everything on immediate silver prices. It removes emotion from the decision. You're not making a dramatic all-in choice. You're simply directing savings flows. It maintains flexibility. If silver prices rise substantially, you can shift the percentage. If prices fall, you continue accumulating at lower cost basis. Once a meaningful position is established, rebalancing becomes important. If silver appreciates dramatically relative to your other holdings, trim the position and redeploy capital. If it falls, potentially add if conviction remains high. This mechanical approach prevents both greedy overconcentration and emotional abandonment. If you're not yet a significant asset holder but want to develop financial security, precious metals deserve consideration as a foundational component of wealth building. This is different from existing asset holders. You're not rebalancing, you're building positions from the start. A reasonable framework involves treating precious metals as part of emergency preparedness. Just as you might maintain 3 to 6 months of cash reserves for emergency needs, you might also maintain some portion of wealth in precious metals. Why? Because precious metals offer something that cash and financial assets cannot provide. Direct, portable, globally recognized value that doesn't depend on any institution's solvency. For newer investors, dollar cost averaging is an exceptionally powerful tool when applied to precious metals. Rather than trying to predict the perfect entry price, something even professional investors struggle to accomplish, commit to regular, recurring purchases regardless of price. Purchase silver monthly, quarterly, or whatever interval makes sense for your cash flow. This approach accomplishes several goals. You're not trying to time the market. You're simply executing a plan. You accumulate meaningful metals without a dramatic capital outlay. You're practicing the fundamental investment virtue. Regular, systematic positioning, regardless of noise. Over time, this approach builds substantial precious metals holdings with minimal emotional drama. Should you own physical metal or paper derivatives like ETFs and futures? This decision depends on your risk tolerance and philosophy. Physical precious metals offer complete control and independence from financial system risk. You hold the asset directly. It cannot be seized by a financial institution experiencing difficulty. It has value in any scenario. Paper instruments like ETFs and futures offer liquidity and convenience. They're easier to buy and sell. They require less storage consideration. For a primary portfolio hedge, physical metals serve the purpose best. If you're using metals for tactical trading, paper instruments work fine. A reasonable approach combines both. Hold some physical metal for core, long-term holdings. Use paper instruments for active trading or positioning. The single most common mistake is buying precious metals at emotional peaks, when prices have already risen substantially and media attention is maximum. This happens predictably. For years, precious metals receive little attention. Prices trade in familiar ranges. Then something shifts. Geopolitical headlines spike. Inflation reemerges. Financial system stress becomes visible. Suddenly, everyone's talking about precious metals. Prices spike. And that's when retail investors enter. This is the exact opposite of rational investing. You're buying when enthusiasm is maximum and prices are elevated. Avoid this by committing to your allocation plan before emotion strikes. Decide in calm moments what percentage of your portfolio belongs in precious metals. Commit to regular purchases. Execute the plan regardless of headlines. When you see media coverage of precious metals surges, use it as a signal to reduce, not increase, your buying. A second critical mistake is deploying excessive leverage to precious metals positions. Leverage is tempting. If you believe prices will rise, borrowing to increase your position amplifies returns, but leverage also amplifies losses. And precious metals can be volatile in the short term, particularly silver. Avoid leverage entirely for core hedging positions. You're not trying to make a fortune. You're diversifying your portfolio and protecting against tail risks. Leverage is antithetical to this goal. Similarly, resist the temptation toward overconcentration. If precious metals become compelling, your instinct might be to allocate excessively. Instead, maintain discipline. 5 to 10% allocation is sufficient to provide hedge value. More than that introduces concentration risk. Physical precious metals introduce practical challenges around storage and custody. If you buy silver bars or coins, you must store them somewhere. Your home safe carries theft risk and insurance complexity. Bank safety deposit boxes carry fees and potential access issues. Third-party vault services carry counterparty risk and fees. All of these options have trade-offs. None is perfectly safe or perfectly cheap. But ignoring this question and discovering storage challenges after you've accumulated metals creates problems. Make storage decisions intentionally before accumulating metals. Understand the costs and risks involved. Factor them into your decision. A reasonable approach involves storing some metals at home in secure locations and using professional vaults for larger accumulations. This balances security, accessibility, and cost. Precious metals are not wealth generators in the traditional sense. They don't produce income, they don't grow, they're insurance. If you expect precious metals to compound at high rates, you'll be disappointed. Their value lies in maintaining purchasing power and providing stability when financial assets are stressed. Avoid the mistake of treating precious metals as a replacement for equity investing or bond holding. They're a complement, not a substitute. Your core wealth building should come from productive assets, equities, real estate, human capital development. Precious metals are the insurance that protects that wealth. Precious metals come with specific tax treatment that varies by jurisdiction. In many countries, gains on precious metals held short-term carry higher tax rates than stocks. Selling triggers capital gains tax. Storage is not deductible. These details matter to net returns. Understand the tax implications before building positions. Factor them into your strategy. Consult a tax professional if your metals holdings are substantial. Finally, avoid the constant reassessment trap. Once you've established your allocation plan, avoid obsessive monitoring and emotional reassessment. Markets move, prices fluctuate, news cycles generate drama. None of this should alter a core allocation decision made in calm moments. Set quarterly or annual review periods. Rebalance if allocations have drifted meaningfully. Otherwise, stay disciplined. Don't trade on noise. The bond market is speaking clearly, and we should listen. Rising yields, particularly when they rise despite central bank resistance, signal genuine scarcity of capital and real pricing of risk. Investors are demanding higher returns because they sense vulnerability. The inversion of yield curves, where short-term rates exceed long-term rates, is historically associated with recession and financial stress. We've seen yield curve inversions in recent periods. This is not a guarantee of future events, but it is a signal to take seriously. The spread between government bond yields and corporate bond yields is widening. This means investors are demanding substantially higher compensation to lend to companies versus governments. The signals fear that corporate earnings and creditworthiness may deteriorate. All of these signals point in the same direction: financial system stress, and stress typically benefits precious metals. Equity markets remain relatively elevated by historical standards, despite underlying risks. This disconnect between valuations and risks is worth noting. High valuations during periods of elevated risk typically precede significant corrections. Not always immediately, but eventually. When corrections occur, and when they're accompanied by recession or financial stress, capital flees equities. Some flows go to bonds, but bonds aren't offering obvious safety anymore, given rising yields and potential duration losses. Capital increasingly flows to precious metals and other non-correlated assets. One of the most significant signals from professional investors comes from central banks themselves. Central banks, after decades of dormancy, are actively accumulating gold. China, Russia, Turkey, India, and other central banks are buying gold at steady rates. This is not casual behavior. Central banks don't speculate. They hedge. Why would central banks hedge into gold? The most logical explanation is concern about currency instability and potential systemic stress. They're protecting their nation's reserves by diversifying away from currency exposure. This behavior, more than any other institutional signal, suggests that professional macro observers are positioning for scenarios that traditional monetary policy cannot resolve. For decades, we lived in an era of relative monetary abundance. Central banks printed money freely. Yields were suppressed, asset prices inflated, credit was easy. This era is ending. It's not ending overnight, but it's ending. Rising yields reflect real scarcity. Tighter monetary conditions reflect genuine constraints. Asset price volatility reflects uncertainty about what happens next. In this transition, traditional portfolios optimized for abundance become misaligned. Those portfolios worked brilliantly from 2008 to 2020. They're likely to underperform significantly from 2020 onward. Precious metals, and silver specifically, are optimized for an era of constraint. They provide value when abundance ends. Energy and commodity prices are beginning to reflect genuine scarcity in ways they haven't for years. Oil, copper, rare earth elements, and agricultural commodities are increasingly constrained by depletion, geopolitical disruption, and environmental limits. This scarcity typically drives inflation. In inflation environments, precious metals historically provide the best protection. Not perfect protection. Nothing provides perfect protection, but better than alternatives. Demographics are shifting in ways that impact financial systems profoundly. The aging of developed world populations means fewer workers supporting more retirees. This creates pressure on social programs and government budgets. It increases the likelihood of monetary instability and inflation as governments try to maintain commitments despite shrinking tax bases. Younger populations in developing countries create labor abundance in some regions and growing demand in others. This creates competitive pressure on wages and margins, potentially limiting inflation in some sectors while driving it in others. These structural shifts take decades to play out fully, but they're already visible, and they reinforce the case for precious metals as a long-term hedge. Geopolitical tensions are driving real fragmentation in global trade and financial systems. Supply chains that developed over decades in an era of relative stability are fracturing. Production is being reshored. Trade relationships are shifting along geopolitical lines rather than pure economic efficiency. Financial systems are being weaponized. Capital flows are being restricted based on geopolitical alignment. In a fragmented world, where trust is lower and borders matter more, precious metals become more valuable. They don't require trust in any particular nation or institution. They're valuable everywhere. The US dollar has been the global reserve currency for decades, but reserve currency status is not guaranteed. It's based on relative stability and strength, not divine right. As US debt accumulates and the dollar is used as a geopolitical weapon, other nations are exploring alternatives. China is promoting the yuan. Europe is debating euro expansion. Multiple nations are looking at commodity-backed alternatives. We're likely not seeing the end of dollar dominance in the near term, but we are seeing the beginning of the end of dollar monopoly. In this transition, precious metals serve as a neutral store of value, not dependent on any currency status. Energy security is becoming a central geopolitical issue. Nations dependent on energy imports are competing for resources. This competition is driving real tensions and creating supply instability. Silver, beyond its monetary role, is critical for energy transition technologies. As competition for energy intensifies and energy transitions accelerate, silver demand will likely rise substantially. Effective strategy begins with honest self-assessment. Where are you in your wealth journey? Are you early career, building initial wealth? Are you mid-career with substantial accumulated assets? Are you near retirement or retired? What's your risk tolerance? Can you tolerate volatility? How would you respond if your precious metals position fell 30% in a year? What are your time horizons? Are you planning for next year, next decade, or decades beyond? What's your philosophy? Do you believe financial system risks are genuine? Do you find precious metals philosophically appealing, or do they feel strange and uncomfortable? Honest answers to these questions should drive your strategy. If you're early career with decades ahead, you can take more volatility. If you're near retirement, you should be more conservative. If financial system risks feel abstract, smaller allocations are appropriate. If you see genuine danger, larger allocations make sense. Rather than making one large decision, consider a staged approach that builds conviction over time. Before committing capital, spend time educating yourself. Read history, understand the arguments, build genuine conviction. Make an initial small purchase, perhaps $500, $1,000 worth of silver. Take delivery if possible. Hold the metal. Experience what it feels like to own something tangible. After some time, assess your experience. Do you feel better about your financial security? Does the allocation feel appropriate? Has your conviction increased or decreased? Based on your assessment, make a deliberate decision about larger allocation. Scale gradually over months or years. This staged approach prevents both paralyzing indecision and emotional overcommitment. You're building conviction through experience, not abstract belief. Even within precious metals allocation, risk management matters. Establish a maximum allocation percentage. Let's say you decide 10% is your target. Don't exceed it, even if prices are rising and enthusiasm is high. Establish a rebalancing band. If precious metals exceed 12% of portfolio value, trim back to 10%. If they fall below 8%, add back. This forces you to sell high and buy low, the fundamental investing virtue. Establish a time-based review schedule. Quarterly, annually, or semi-annually, review your position. Make intentional adjustments. Avoid constant monitoring. These mechanical rules protect you from both emotion and overconfidence. Precious metals allocation shouldn't be an isolated decision. It should integrate with your overall financial strategy. How does precious metals allocation affect your emergency fund sizing? If you hold some wealth in metals, you might maintain slightly smaller cash reserves. How does it affect your equity allocation? Most investors should maintain meaningful equity exposure for growth. Precious metals don't replace equities, they complement them. How does it affect your bond allocation? With rising yields, bond allocations might increase in appeal, but precious metals provide different hedge value. How does it affect your real estate strategy? Physical property is another form of tangible asset that provides different benefits than precious metals. Successful financial strategy integrates all components into a coherent whole. Humans are social creatures. We take comfort in consensus. If everyone around us is positioned similarly, we feel safer, even if that positioning is actually risky. Precious metals. Allocation positions you against consensus. Most investors hold minimal precious metals. Most financial advisors don't recommend them. Most institutions don't emphasize them. This divergence creates psychological discomfort. When markets rise and financial assets outperform, you'll feel foolish for holding dead money. You'll hear criticism. You'll question your decision. This is the burden of contrarian positioning. It's also the source of contrarian returns. Prepare yourself for this psychologically. Understand that discomfort is part of the process. Spend time with your rationale. Understand your conviction. When doubt strikes, and it will, remind yourself why you made the decision. Rather than wrestling with these questions alone, consider finding like-minded investors. Financial groups, investment clubs, or online communities focused on precious metals and macroeconomic analysis can provide community, not for cheerleading or echo chambers, but for serious discussion and shared discipline. When you're part of a community that understands your positioning, discomfort decreases. You're not alone. Others are thinking seriously about the same questions. Finally, cultivate a long-game mentality. Financial markets operate in different timescales. Short-term volatility is normal. Intermediate-term cycles matter. Long-term trends determine wealth. Precious metals are a long-term positioning. You're not making a bet that prices spike next month. You're positioning for a structural shift in the financial system that might take years to play out. This long-term perspective is liberating. It removes pressure from daily price movements. It allows you to stay disciplined when noise is loudest. We've discussed significant financial risks, debt accumulation, rising yields, geopolitical tensions, systemic vulnerabilities. This can sound alarming. But here's the empowering truth. Financial fragility is fixable at an individual level. You cannot control whether the central bank maintains monetary stability. You cannot control whether geopolitical tensions escalate. You cannot control broad macroeconomic cycles. But you can control your own portfolio. You can take deliberate steps to reduce your personal fragility. You can position for multiple scenarios rather than betting everything on one outcome. That's not speculation. That's prudence. One of the greatest gifts of disciplined financial strategy is optionality, the ability to respond flexibly to whatever actually happens. By maintaining precious metals allocation, you're buying optionality. You're saying, I'm prepared for multiple futures. If financial systems remain stable and equities perform well, you own equities. Precious metals will underperform, and that's fine. You're still building wealth. If financial stress emerges and currency weakens, your precious metals protect your purchasing power. Your alternative assets hold value when traditional assets decline. Either way, you're in a strong position. You have options. Beyond specific financial returns, there's a deeper psychological value to financial preparedness. When you've genuinely thought through risks, made intentional decisions, and positioned accordingly, you sleep better. You're less anxious. You're more resilient. This psychological resilience is itself valuable. Stressed people make poor decisions. Prepared people maintain discipline. By building financial security, including precious metals allocation, you're also building psychological stability. That stability carries value that transcends portfolio returns. Here's what I want to emphasize most strongly. You have agency. You're not a passive victim of financial systems. You're an active agent in your own financial life. The financial system may face pressures. Institutions may fail. Markets may dislocate. But you, as an individual, can take deliberate steps to protect yourself and your family. This is neither alarmism nor complacency. It's realism, and it's empowering. We've explored a complex financial landscape where multiple forces converge dangerously. We've discussed the global debt structure that has grown unsustainable. We've examined the yield environment that reflects genuine scarcity and risk. We've considered geopolitical tensions that amplify financial stress. And we've explored how silver, as both a monetary hedge and an industrial commodity, sits at the intersection of these forces. We've provided specific, actionable strategies for both existing asset holders and newer investors. We've identified behavioral mistakes to avoid. We've discussed how to integrate precious metals allocation into a broader financial strategy. Most importantly, we've emphasized discipline, long-term thinking, and emotional resilience. If you take nothing else from this analysis, take this. Begin the process of understanding your financial exposure and intentionally diversifying it. You don't need to make dramatic changes. You don't need to liquidate existing holdings or make emotional decisions. But you do need to begin. Begin researching. Begin thinking. Begin small if it helps, but begin moving capital allocation toward genuine diversification. The decision doesn't need to be made today, but delay is expensive. The more time that passes, the more you expose yourself to concentrated risk. Begin now. We live in an era of significant change. Old certainties are breaking. New realities are emerging. Financial systems that worked for decades are straining under their own contradictions. This is neither cause for panic nor excuse for complacency. It's cause for clarity. And clarity, combined with disciplined action, is the foundation of resilience. You're capable of building that resilience. It requires thought. It requires discipline. It requires the willingness to position against consensus when conviction is warranted. But it's entirely within your control. Financial wisdom isn't sophisticated. It's not about finding hidden alpha or predicting futures with certainty. It's not about timing markets or getting rich quick. Financial wisdom is about understanding risks, allocating capital deliberately, managing emotions, maintaining discipline, and building optionality. That wisdom is available to everyone. It requires no special skills, no insider information, no luck. It requires only commitment to thinking clearly and acting deliberately. We began by noting that multiple forces are colliding: debt accumulation, rising yields, geopolitical tensions, and systemic fragility. We've explored why precious metals, and silver specifically, matter in this context. Not as speculation or gambling, but as insurance and diversification. We've provided concrete frameworks for action, whether you're building an initial position or rebalancing existing holdings. Most importantly, we've emphasized that you have agency. You're not powerless. You're not a victim of forces beyond your control. You can take deliberate steps to reduce your fragility and build resilience. That's the message we leave you with: clarity, discipline, and action. The future will unfold as it will, but you can face it from a position of strength rather than weakness. And that choice, the choice to build that strength, belongs entirely to you. Thank you for investing your time in this analysis. We genuinely appreciate it. If this framework resonated with you, if you found value in thinking through these forces systematically, we invite you to remain part of this community. Subscribe to the channel. Join us for future explorations of financial systems, market cycles, and the principles of resilient wealth building. The conversation continues. The work of building financial resilience is ongoing. We're honored to help you through that process. Until next time, remain disciplined, stay informed, and remember, the most important financial decisions are the ones you make in calm moments before emotion strikes and crisis forces your hand.